Hi, this is Hutch, and today we're going to take a deep dive into IUL and all the different index crediting strategies you have available to you in this crazy era of wacky volatility and low interest rates. So you can see if IUL is going to be a good place for your money. It's not a good fit for everybody, but hopefully us taking a deep dive with these crediting strategies, we'll see if this is a way you want to attempt to grow your money inside of fixed insurance products. So with that, this is our indexing calculator. It's brand new. We have lots of different indexes to choose from, and so do you. It's not just about, hey, what's the S&P cap on your IUL? There's some different strategies that we're going to explore. There's uncapped strategies, and there's some unique, lesser known indexes that we're going to look at later in this video. What you have under the index are what the averages are, and the blue is going to be the raw market, in this case the S&P, and the green is going to be when we add the constraints that are below that. And you can see we have a 0% floor, a 9.75 cap, which is about average these days. Some caps are lower, some are a little bit higher, but most carriers are saying, with today's options pricing, because volatility went up, the cost of options get more expensive. And so therefore, the insurance company has less money to be able to put towards options to hedge so you can get growth in your IUL, especially since interest rates have come down. So most carriers are saying that a 9-ish, 10 cap is about what you can afford in today's environment. And carriers that are doing more than that are really kind of subsidizing with extra costs in the back end. But costs are a different story. It's actually a totally different video. If you're interested in looking at IUL charges, go to this video here. Let's just explore devoid of charges, testing and measuring different index crediting strategies. So over on the right is a 20-year table, but you can see we're actually doing a longer study period. In this case, 84 years of the S&P. But whatever shows up in that 20-year window on the right, we're actually going to have not only a graph, but we're going to have some averages just for that 20-year window. And if we go through time of the S&P, we can see the green, the constraint index, actually does really well the first 20 years. You're ahead the whole time when there's a lot of volatility in the S&P. Now think about it. You start with $100 and you're below $100 a lot of time for the first, looks like 11 years. And then finally you get above 100. But even with a very conservative cap and steady crediting, you're actually way ahead up until that 19th or 20th year. As we scroll through time, it continues to kind of bob and weave, and there's no real clear winner here. And now we're all the way out from 1936 to 1965. The S&P is starting to pull ahead because that was a very bullish time. Now through the late 60s and the 70s, things got very chopping. There was decades of basically no return and just a lot of volatility, some of which people are saying that may happen now. Other people are saying with all the stimulus, things could be very bullish. Nobody really knows. But what we do know is when the market goes down, it goes down very quickly these days. We had a 30% drop measured in a period of months. And we may never see a period like this, the rip-roaring 90s, again, because think about it. Defined benefit pension plans started to become a thing of the past. And so companies started moving to the 401k model where clients or workers started putting money in the market where before you needed to be able to afford 100 shares of stock at an expensive stockbroker. But now they could use mutual funds to buy all these stocks, incremental fractional shares. So what happens when lots of people are buying stocks? They go up. And if we just pivot to the next 20 years, this goes right up to 1999. If we pivot to just the next 20 years on its own with that 9.75% cap, what you can see is that $100, again, we're just bringing it back to 100. You would have been below throughout the last decade. In fact, it would have taken a long time to catch back up. And you would have been ahead of the game the whole time, even with a very conservative cap. Let's take a look at some uncapped options. So up until recently, several carriers had an uncapped S&P strategy with a spread of 5. Now, what a spread is a fee that you only pay when you win. Meaning if you earn 6%, the first 5 goes away, you only get 1. But if you only get 3%, you don't go down to -2. It just means you get 0. The 0% floor supersedes the spread or the fee that you only pay when you win. Now, if we look back all the way to 1991 and we look at that meteoric rise of the advent of mutual funds and the raw index in blue, you can see the uncapped strategy -5 actually holds up pretty well. And when things came crashing down after the tech bubble in the early 2000s, obviously the uncapped option held its own and was able to keep up on its way back up to 2008 and then just pull far ahead. Now, if we look at just the last decade from 2011 to 2020, you can see just looking at those 20 years, it stayed ahead the whole time. And we've had some very nice returns over the last few years. Obviously, there was a zero in between, but the raw index couldn't keep up with the uncapped using a spread of 5. Now, fast forward to today. What we've had recently after coronavirus is crazy volatility. So what happens to options pricing is it gets significantly more expensive. When carriers raise spreads, which is what has happened, so not just a spread of 5, but a spread of 8, when they raise the spread to 8, they're not keeping extra profits. What's happened is pricing of options have gone up. And this can be measured in something called the VIX, or the volatility index. And what it measures is hedge fund managers and institutional money managers buying S&P options as like insurance for the portfolio. And when the market tanks 30% or 20%, when the sky starts falling and it's losing 1,000 points a day, it's almost like trying to get life insurance when you just got diagnosed with terminal cancer. Nobody will sell you life insurance, but somebody will still sell you portfolio insurance with options. It's just incredibly expensive. And so that's why we're seeing now a spread of 8. And again, if we just back it up to 1991, you can see it does okay. Not as great during that meteoric rise. And if we scroll through through the last decade and to the last decade, you can see again it does okay. It's just not quite as attractive of an option. All right, so let's really drill down to the last 20 years, because I think that's indicative of not only the best times in the S&P, but some of the worst times as well. Obviously, we had the lost decade, and then the last decade was pretty good, but there was a lot of volatility throughout, and that may be what we're in store for going forward in this crazy time we're in. So we're going to first look at the S&P 500 with the uncapped and the 8% spread. And what I want you to see on the far right-hand column is there's a lot of zeros. There's more so than with the capped, even with the low capped. And in years like 2004, where the S&P did almost 9%, you only get 0.99 with an 8% spread. In 2006, you get a meager return where you would have hit the cap otherwise. In 2010, similar story. In 2012, similar story. In 2014, similar story. In 2016, similar story. Now, thankfully, in 2019, you can see we really hit a nice home run there. Maybe not a home run, but at least a good solid triple, to where it brings the average of the whole study period up to 5.47. However, things were lagging there before that, as we'll see in just a moment. Okay, so if you train your eyes on the far right-hand side, what you're going to see is there's less zeros now. You don't see any double-digit returns because we have this 9.75% cap, but what you see is a lot steadier crediting. So you can see in that 2004, you got 8.99. In the 2006, you hit the cap. In 2010, you hit the cap. In 2012, you hit the cap. So there's still some zeros, but there's a lot steadier crediting. In some of those years, like 2005, where you would have gotten zero with an 8% spread, you actually get the 3 points. In 2007, similar story. You get 3.5% instead of losing that by taking some kind of spread option with the first 8%. So what does this mean? Nobody really knows for sure, but this is an opportunity for you to say, okay, should I blend some of these strategies and maybe with some of my cash value swing for the fences and another portion of my cash value just go for steady crediting, or really just take a look at what kind of person you are. Maybe you just want the steady crediting. What we're going to look at in just a moment are some other options to get uncapped returns and also steadier crediting. Changing gears for a moment, here's a new and innovative way to get uncapped crediting. So one carrier started tracking, instead of the pure S&P, the S&P Low Volatility Index. And this is not a piece by any insurance company. This is actually a piece by S&P Dow Jones indices who actually construct these indices. And so the S&P low volatility index, what it does is it tracks the performance of the 100 least volatile stocks in the S&P. And what it does is it weights those stocks by the inverse of their volatility measured by standard deviation over the trailing 12 months. And the 100 stocks, as you can see down here, they're going to be rebalanced every quarter, February, May, August, November, by looking back at their volatility for the last 12 months. So what does that mean for you? What it means is, since we know that increased volatility increases options pricing, since these are naturally lower volatility stocks to track, it's cheaper for the insurance company to hedge. Okay, so how does that translate to performance? Well, before all the wackiness happened in Q1, you could get this index and track it with a 90% participation rate. So instead of a spread that eat up your first 5 or 8 points, you would start tracking this index from $1, but instead of getting 100% of what the index did, you would only get 90. Again, it has to do with options pricing. And we can see that by looking at the graph, it did very, very well from 1991 on. And if we track it through the last decade, it was actually crushing throughout. If we compare it to the 5% spread, we can see this one averaged 9.48% over the 29 years, and the 5% spread 9.39. So pretty apples to apples. Well, enter COVID-19, and what do we get? We get a 75% participation rate. Okay, let's look back to 1991. Well, it's not tracking it quite as nicely, but let's see how it does going up to the last decade. Does pretty well, and through the last decade, actually holds its own nicely. And again, that problem of not getting any crediting when you had those meager returns, you don't have that. If you look down the far right-hand side of the green column, what you see is there's not nearly as many zeros, especially since you're dealing with the 100 least volatile stocks. A lot of them tend to be defensive stocks during bad times. So this is a very unique way. And again, this got lowered to 75%. It may get lower at some points, but this is a pretty nice way to track returns. If we look at the average over the last 29 years, it's 7.9%. Now, we can't show you that through an IUL because for an IUL, we have to use just the 1-year capped option. But this is a pretty nice back test of how things could have looked. And when we isolate just the last 20 years, the last decade and the last decade, it's just crushing the raw index the entire time. And our average is 7.54. Even if we just isolate the last decade by itself, 2000 to 2009, things look pretty good at 6.75. And look at the returns over on the right. Yes, there's some zeros, but there's some pretty nice returns along the way. Now I'm going to do something crazy here. Now you can't buy this in any IUL, but I want to test the Dow Jones Industrial Average because unto itself, it's sort of a low volatility index. But unfortunately with the S&P low vol index, we can only go back to 1991. With the Dow Jones, we can go all the way back to 1929. And there were 0% years the first years. It lost like 70 something percent of its value during that 4 years. And what we can see is even with the 45% participation rate on the Dow Jones Industrial Average, you were ahead almost the entire time during that 91 years, and it finally catches up and just barely beats parameters similar to a low volatility index. Now, it's not apples to apples, but it's something close. Instead of the 100 lowest volatility stocks in the S&P, we're talking 30 extremely low volatility stocks. And I just wanted you to see the history. Even if I isolate the the first 10 years from 1929 to 1938 with those 4 zeros, what you can see is I put now a 37% participation rate, and you still average 6%, which is about what you're seeing these days on these IULs. So again, you can't do this. I just want you to see that regardless of what type of times we come into, this is still a very viable option for you.